As an investor, when shopping for loans, it's very important to know the difference in type of loans and how they benefit you. So maybe as a first-time investor or even as a first-time buyer, you're trying to get into the real estate game and you think maybe all loans are the same or about the same, or one lender can offer you every single type of loan, and that's not reality. So as an investor, you have a couple options. Usually, I would say the one that most people know about is a hard money loan. So hard money loans are loans that are for investment type properties only. They usually require a decent size of down payment. Usually they carry higher interest rates than regular loans, and they carry usually a couple extra fees as well, compared to a regular loan. However, they tend to be quicker in closing. So as an investor, if you want to buy a house that's going by quick, or maybe it's a cash deal and you don't have the cash but want to be competitive in your offer, you might choose to go with a hard money loan because they usually tend to close quicker. You could be a week, couple weeks usually. Uh, there's several variations of those. Like I've seen some where no credit score is required, or appraisal for some people, and some where it is. So it just depends on your qualifications and the numbers of the deal. Uh, Now it is I would say a temporary loan. So usually you're doing a hard money deal for maybe 6 months, 12 months, 18 months because of the higher interest rates, right? You don't want to be paying that forever. You can make them interest only, and those are a couple benefits there with interest only in the short-term loan. And the reason I see that is because of this. With interest only, even though you have a higher interest rate, your monthly payment might be lower than a regular loan, or about the same. So that's a benefit there. Plus, with the short-term loan, you're really just looking to fix the house up quickly. You're either going to sell it after you're done, or you're going to refinance it into a regular investor loan, which we'll talk about here in a minute, and get a normal interest rate there. So it's just like a short-term gap, right? Think about it that way. But it gets you a property, gets you maybe some equity, hopefully with the rehab that you did to the property. And if you decide to keep it, it gets you also some rental income that you can use as potential income for yourself or for other investments down the road. So those are some of the perks with hard money loans and some of the cons. Now, I mentioned before that you can maybe refinance it to a regular investor loan, or even what's called a DSCR loan. And in those type of loan programs, your interest rate is not as high as a hard money loan. You're more qualified on the property and the numbers of the property, what the rent of the property is compared to your mortgage payment on it. But you can get that for a long-term loan, right? 20 years, 25, 30 years. Keep your rental property, have it cash flow, get that money either for property improvements, or save it and store it to use for another investment down the road. But it gets you out of your hard money loan, and you're not paying that higher interest rate now. And it's a great benefit for all your rentals to have. You can do some type of portfolio like loans for these investment DSCR loans for people that have more than one property, have multiple type properties. Now, for a regular buyer, maybe trying to buy their primary home, these type of loans are not ideal for you. And even the hard money banks, let's call them, don't necessarily do some of these regular loans, right? They're done somewhere else. So you gotta have a couple contacts, and that's where I come in. The person that does the regular investor loans, or somebody looking to buy their primary home, I do those type of loans. Those are all a bunch of different loan programs. There's several of them, and I have several videos talking about them, so you can watch those for more details. But point being is, they're not done with hard money lenders. The interest rates are lower. Your primary house, your down payment is way lower, and just your whole benefit package, let's call it, is way better if you are buying a primary home. Now, there's a little bit more restrictions, right? It takes a little bit longer to close, maybe 3-4 weeks instead of 1 to 2. It's going to take a little bit more paperwork with income verification, things like that, because now we need your income to support the loan compared to the property supporting the loan. So those are different perks. between each one as well as different cons. So it's really just depends what you're trying to do. I have several people that just buy a primary home once a year, right? Live in it for 12 months. After 12 months, they can rent it out, go buy a different one, and they go buy another one. And they keep repeating that cycle until they can't no more. And that's how they build their investment portfolio. But now they don't need that bigger down payment, and they're not getting the way higher interest rate. Now the con to that option is that they're maybe not building equity as quickly as you would in a hard money type loan as an directly as an investor, right? So they each have their pros and cons, and it really just depends on your situation, financial situation, and living situation, and also your investment mentality, and how much risk you're willing to take, because they all have their own different type of risk and investment requirements, and I would even say stress and emotional stress on you. So there's really no right or wrong answer. It just depends on the numbers, I would say, and what you're willing to do.